We've got Herve Andres from Paris. Is it Paris? You're
yes,
based?
Paris.
Yeah. From Milliman in Paris, he is going to share some insights on path-dependent implied vol. And I'm sure it'll be a fascinating talk. We've got the slides up, so over to you.
Hi everyone, so thank you for the introduction, Malcolm. So to introduce myself very quickly, I'm a third-year PhD student at Milliman, and this PhD is in collaboration with the CERMIX, which is the research laboratory in applied mathematics at École des Ponts in Paris. And so the work I'm going to present is a joint work with my PhD supervisors, so Alexandre Boumezoued from Milliman and Benjamin Jourdain from CERMIX. So the general topic of this presentation is that of real-world economic scenario generators. So basically, real-world economic scenario generators are softwares allowing to simulate economic variables such as interest rates, equity, inflation, etc. And these simulations are expected to be realistic in view of historical data. And these tools have become really key inputs for many applications. So in the first talk, you have seen one application, because for the asset allocation, you need to project your assets. But there are also, you can use it for the computation of regulatory capital requirements, or more generally in ILM studies. And the starting point of this work is the observation that in many current ESG, so economic scenario generators, real-world economic scenario generators, there is one risk factor that is either not modeled or modeled through quite simple assumptions, and this risk factor is implied volatility. And so the problem with the simple models, especially, is the fact that they do not reproduce a key stylized fact of historical data, which is the fact that implied volatility is not independent from the price of the underlying asset price. So when the price drops, you observe a spike in the implied volatility. So if you want to do realistic simulation of implied volatility, this is one of the stylized facts you would like to be able to reproduce. So for those that are maybe not familiar with implied volatility, this is just a gentle reminder. So if I give you the price of a European call option, you can find a unique parameter, sigma, that when you plug it into the Black-Scholes formula, you actually retrieve the initial price that I gave you. And this unique parameter is called the implied volatility, so the Black-Scholes implied volatility. And according to the Black-Scholes model, this implied volatility should be the same for all maturities and all strikes. But in practice, if you take option prices from the market, then you compute these implied volatilities based on these market option prices, and you observe that these implied volatilities both depend on the strike and the maturity. So actually, you need an implied volatility surface to describe what is happening on the market. So this is the first observation, and the second one is that this implied volatility surface is not constant over time. So if you look at the implied volatility surface 1 year ago or today, it is very likely that the level and the shape is not exactly the same. And so our contribution, the problem that we are addressing, is the one of simulating jointly the full implied volatility surface and the underlying asset price under the real-world probability measure. And the key idea to do that is inspired from the stylized fact that I described before on the graph, is to make the implied volatility dependent on the past path of the underlying asset price. So to make this idea a bit more precise, I need to talk about a key work that inspired this work, which is the one of Guyon and Lekeufack last year. And they published a paper called Volatility is Mostly Path Dependent. So what does it mean? So they introduced this very simple model where you say that volatility is basically a linear regression on two features, R1 and sigma. R1 and sigma are respectively weighted average of the past returns of a given index, so for example the S&P, and sigma is a weighted average of the past square returns. So basically the same as R1, just you take the square and you take the square root to get an homogeneous quantity. And here the volatility is kind of a proxy of the spot volatility. So they consider either a volatility index such as the VIX for the S&P, or they consider realized volatility that you compute from square returns. And their conclusion, when they calibrate this model, is that this model allows to very well explain the variations in the volatility. So they measure the R2 scores and they obtain very high R2 scores. So here is the agenda of the presentation. So introduction, motivation is already done. Now I present an empirical study that is extending the one that I just briefly presented. Then I represent the model allowing to make this joint simulation. And finally, an application in the insurance industry for the hedging of RILA products. So the empirical study, so basically the study of Guyon and Lekeufack focuses really on spot volatility of an equity index. So for example, take the S&P to fix the IDs. And we wanted to see whether these conclusions could extend to implied volatility. So we considered historical evolution of daily implied volatilities. So here only at the money implied volatilities. And we calibrated the model that I showed you, so the linear regression. And what we obtained, so the results are on the two graphs. So on the left, for the S&P 500 and on the right for the Euro Stoxx 50. You have the R2 scores, so in blue for the train set and in orange for the test set. You have the R2 scores for each maturity because basically the implied volatility depends on the maturity. So for each maturity, we performed this calibration. And the first key finding is that, well, implied volatility also seems to be path dependent because the R2 scores are also very satisfying. Still, the past path of the underlying asset price explains a large part of the variation of the implied volatility. So this is the first key finding. The second one is that you observe a kind of decrease of the predictive performance of this model with the maturity. This is quite expected because you do not expect long-term options to be as sensitive to the underlying asset price as short-term options. And finally, you can see there is a small gap between the trend and the test set results. And so we have investigated a lot this what can be seen as a problem, and it mainly appears to be linked to the peculiar nature of the test set, which includes the COVID crisis. But still, on the test set, you have a good R2 scores. So now the path, so what I call the path-dependent SSVI model, which is the model that will allow us to generate joint simulations of the underlying asset price and the implied volatility surface. So one of the first building block of this model is the so-called SSVI parameterization. So it stands for Surface Stochastic Volatility Inspired. And it's basically a parameterization of the implied volatility surface. or to be more precise, it's a parameterization of the total implied variance, which is the square of the implied volatility times the maturity. This is really a detail. And why do we consider this parameterization? Because it represents a very effective way to reproduce a market implied volatility surface at some date. So it fits, this model fits very well market implied volatilities with a small number of parameters. And as a bonus, you have sufficient conditions, quite easy, that prevent arbitrages. So you have the definition of the left. It's not very important. What I want to underline here is the parameters of these parameterizations. So you have one parameter theta t per maturity t modeled, one parameter rho that lies between -1 and 1 that is basically independent from the maturity, and then you need to specify a function phi that has some regularity, and we took the following one, so kind of a power law function that depends on two parameters, eta and gamma. So here you have an example of the calibration of this parameterization for two dates, for the S&P 500 and the Euro Stoxx 50. And as you can see, it's very satisfying. You reproduce very well the shape and the level of the implied volatility. Now, there is still a problem at this stage. So I said there is a small number of parameters, but you need one parameter per maturity to reproduce an implied volatility surface. So in the previous example, you have 24 maturities, so 1 month to 24 months. So you need 24 parameters plus the 3 others. So at the end, you have here 27 parameters. So this is quite heavy, especially since our objective is to put a dynamic on these parameters to be able to obtain a dynamic model, because this is fully static. So we had to make two assumptions to reduce this number of parameters. The first one is to consider gamma is equal to 1/2 in the function phi here. And the second one is to consider a parametric form for theta t, which is the parameter that generates a lot of parameters in the calibration. So it basically is a power law that depends on two parameters. So when we make these two assumptions that are inspired from our empirical study and data, do not have the time to detail everything. We obtain this parsimonious version of the SSVI parameterization that depends, so at the end, only on 4 parameters, and this number of parameters is not dependent on the number of maturities that you want to reproduce. So the question at this point is, well, what do I lose because I reduce the number of parameters? So I must lose in the accuracy of the calibration. But when we compare the mean relative error of the full model with all the parameters to the parsimonious one, well, and we perform this calibration on all the dates of our historical data, so from 2012 to 2021. Actually, it's quite close, and in average, it's still a very good calibration for our purposes. So now we would like to put a dynamic on our 4 parameters to be able to obtain a way to simulate the evolution over time of the implied volatility surface. And because we made this empirical study at the beginning that says that basically implied volatility depends on the past path of the underlying price, we want to know whether this parameter, we can do the same analysis for these parameters. So basically we fitted the same so PDV model, so path dependent volatility model for each of the 4 parameters. And we observed that for 2 of the 4 parameters, we observed the same feedback effect of the past returns and the past square returns on the value of these parameters. So we have you have the R2 scores in the table. So this was, we were very happy about that. And on the contrary, for the two remaining parameters, so those are rho and eta, we do not have these such results. The R2 scores are basically close to 0. And this can be explained quite easily because these two parameters are more controlling the orientation and the convexity of the implied volatility surface. So it's not as clear that they will the price of the underlying asset will impact this geometry of the implied volatility surface, while A and P are more parameterizing the ATM level, so the antimony level, which is path dependent. So here is now the dynamics of the underlying asset price. So I do not enter into the details. What you have to see here is that it's basically the model that was proposed by Guyon and Lekeufack, but in continuous version. So you say that the spot volatility is a linear regression of two features, and here there are residuals to account for the fact that, well, you have a good R2 scores, but you do not capture everything. Now, same for A and P, because we have seen that they are path dependent. So you have a similar response function as a function of, so a linear function of R1 and sigma. And again, you have this kappa that allows to account for the fact that the R2 scores are not 100%. So these two residuals, as well as the rho and eta that we didn't explain, we model it using a semi-Markov diffusion model. I do not have the time to detail, but happy to answer questions on that. So now, what are our results? Because at the end, so we made a lot of work, but does it produce realistic implied volatility surfaces over time? So the first thing we did is to look at sample path, and we fixed the path of the underlying asset price. So we fix S to the historical path, and we only simulate the historical. We only simulate the implied volatility surface. So A, P, rho, and eta. And when you do that, and you compare to the historical evolution of the ATM term structure, well, you obtain something that is very similar, both in terms of level and in terms of dynamics, because basically the big spike is the COVID. And this is very important to be able to reproduce. And now if we also simulate, because this was a bit easy, let's say, because the underlying asset price is not simulated, we take really the evolution here of the Euro Stoxx 50. Now, if we simulate everything, we still have these spikes, which is really the important feature. And in terms of level, it's quite consistent with historical data. Here you have something that is less, because this was a sample path, but when we aggregate everything, you can look at the quantile envelopes. And this shows that from a statistical point of view, the simulations are also quite reasonable. So let me now conclude on an application. So, because at this point I've talked a lot about finance, but let's talk about insurance a bit. So the application is to so-called RILA products. So this stands for registered indexed annuities, and those are investment products that are offered by some, I think mostly US insurance companies, and these products allow the policyholder to benefit from the return of a given index with both an upside crediting mechanism and a downside protection option. So to give you a bit of insights about these two mechanisms, I've illustrated the payoff of an example of such a product where you have a cap rate of 25%. So if the index returns over 25%, you only have 25%. And on the downside, if the returns is between 0 and minus 20%, you are protected. And it's below minus 20%, you are not protected. Very easy. And so the question we want to address from the point of view of the insurance industry is how do I hedge such product? Because if I sell this product, I need to hedge it. So three options. First one is to use a static hedging strategy. So basically, this payoff can be replicated statically using a linear combination of call and put options. Second option, you use a dynamic hedging strategy. So you invest in a replicating portfolio that consists of the underlying index plus a risk-free bond, and you rebalance this on a regular basis. And the third option is a kind of hybrid strategy where, based on the implied volatility, you can say, okay, here the implied volatility is very expensive, so maybe it's better to dynamically hedge, or maybe the implied volatility is low, so I prefer to statically hedge. So this is something we wanted to investigate. And so we investigated from a numerical point of view using the path-dependent implied volatility model. So we consider basically the 6-year RILA product with the characteristics that I described here on the slide. And so the static hedging strategy is, as I said, a linear combination. So here you buy a call, you sell an OTM call and an OTM put. And the objective is to compare the P&L of the static hedging strategy to the P&L of the dynamic hedging strategy over 1 year. And then at the end of the first year, you buy again the 5-year call option. So to make this comparison, basically you pick an historical date, you calibrate and you simulate the path-dependent volatility model as of this date. And based on these simulations, for each simulation, you are able to compute the P&L of the static hedging strategy and the P&L of the dynamic hedging strategy. For the static, you only need the implied volatility, and for the dynamic, you need the underlying asset price simulations. And so, based on this workflow, you are able to derive the distribution of the P&L of both strategy, and in particular, you can compute the expectation of the P&L for both strategies, and you can decide on other risk measures, but let's say we take the expectation, and you say, okay, the expectation of the P&L of the static hedging strategy is above, so I prefer to statically hedge. And now you can say, here at the historical date that I picked, well, I know what happened. I have the historical path, so I can compare what the model told me to do to what was effectively the best action to perform. And so this is still a work in progress, but at this stage, for most of the historical data, so we have tested, I think, more than 100. In most cases, the conclusion of the model was the same as was the historical action to do. So key takeaways. So we introduce a new model for the joint simulation of the implied volatility surface and the underlying asset price. What we have seen is that the model produces highly realistic paths, so it is a good model within real-world economic scenario generators. And what we have seen in the application to the RILA products is that it provides a good risk assessment of the implied volatility. And more generally, to conclude, I think that this kind of path-dependent model where you have really a causal link between the underlying asset price to the implied volatility is really a promising area of research for real-world financial modeling and more generally, I think, in insurance. Thank you for your attention.
Right. Do we have any questions? Yes, I think we've got one.
Thank you very much for your very interesting talk. Alex Neidegger from Kessler in Geneva, Switzerland. Just out of curiosity, this to me is a topic which typically would be addressed in the banking world. So yes. My question is, who is mandating you? Are you doing this in the frame of an ALM analysis, or who are your who are the stakeholders of this kind of approach? And I assume this approach is not entirely new in the banking world either.
Yeah, thank you for the question. This is a good one. So I'm working at Milliman, and I'm working in a team that is developing an economic scenario generator. So just from this point of view, this is interesting to have such risk factor within the economic scenario generators, because we had demands from clients to have such factor. And within Milliman, there is a financial risk management team that handles such RILA products for the hedging of these products for insurers. And so this is this last part is in collaboration with this team. So that they are able to determine which is the best hedging strategy. So this is really something that has application in the insurance industry, but of course this is also interesting for the banking industry. Still in the banking industry, the horizon of projection is lower, because here you want to do projections until 6 years, maybe more. While in the banking industry, the horizons would be much lower.
Thank you.
Yes, just to add on that, I've worked in asset management for quite a while, and you're quite right that this is the kind of thing that would also appear in bank research or bank trading desks. But it's interesting that this RILA product and some of those other variable annuity products embed those kind of structures, and so it is something that's relevant to the insurance industry. And I would like to say that my overall take is that French actuaries seem to be particularly well versed in some of the mathematics and analysis. So thank you very much for that. Do I have any other questions?
Yeah, hi, Jochen Kienberger from Allianz. We actually also have these products in the US. So I was wondering, if I understand correctly, the question is kind of whether the implied volatility was kind of mispriced in the SEDEX strategy for the 6-year term, right? So does it also work for like the shorter term products with the 1-year term, or is it like the longer one?
It works for both cases, and just to precise on what you said at the beginning. So it's not whether it's mispriced. It's just you have a price that you observe today, and you want to know whether this is based on what happens also before on the underlying asset price. Maybe it's better to well, you have this statistical analysis that gives you can leverage the past to get some information about the future, and this is what we want to show here.
I just had one question, which is kind of linked to whether it's mispriced. You said that you'd analysed how often this strategy seemed to work. Were there any patterns in situations where the strategy seemed to work particularly badly? As a risk manager, this is the kind of question that people would ask.
Yes.
When are we going to be caught out if we follow this
Yes,
approach?
so basically at this stage, it seems that it works not very well to dynamically hedge during year 2019.
Okay.
Because there was the COVID after just 1 year after, so when you, at the end, you are really...
Okay, right, so the answer is avoid the strategy if you think there's another pandemic coming along. Okay, brilliant. Well, I think we're out of time for questions. Thank you very much again, most interesting.